Now let's talk about the institutional side of options trading. So the first thing is talking about the dealer. Now the dealer is just a bank trading desk, and that's what you would call a market maker. So when I was trading at a bank on a derivatives desk, I was a market maker. And what my job was to provide bids and offers to clients and money managers. Basically what that means is people would call me up and say, hey, Luke, I need you to make me a market on Apple 200 Jan calls. Okay, so I would have to then talk to my trader and figure out what's our bid, what's our offer, and what's the size that we want to make. Now, when I'm talking to my trader, he is going to be concerned with a number of things when he needs to make a market. The first thing that he's going to be concerned with is what is the volatility of the stock, right? So someone's coming in to trade the options. He is going to be then thinking, okay, well, how is this stock going to move? He's going to have a model already created for this. The next thing that he's going to be talking about is the liquidity of the stock. Remember, when a bank is taking down flow from its client, it is going to have to hedge that order flow. And so the liquidity of the stock is paramount, and it reflects in the markets that he makes. To a lesser extent, sometimes he might be looking at borrow rates for the stock. So if a stock is hard to borrow, that might actually come into play when he's making a market. And then lastly, the trader is really going to be thinking about unknown or known future events that are happening for that stock. So this could be a known event like an earnings event, but unknown events is if maybe a company has some type of event that they're going to be showcasing at some point, and the trader can only guess at what they're going to reveal. Now, one thing to also realize is that bank traders are making markets every single day, okay? And sometimes, depending on what stock they want to trade or what option they want to trade, they have to make a market that can be wider than the screens. And the reason for that is because liquidity comes at a premium. So let me show you what I'm talking about. So here, let's go ahead and look at what liquidity might look like on this graphic here. So when I talk about liquidity coming at a premium, I want you to look here, and we're talking about Intuit, and these are the April 165 puts. Okay? The first thing to point your attention to is look at the bid size and the ask size. It's just 2, right? So imagine someone calls up and they say, hey, Luke, Intuit, the April 165 puts, where can I sell 1,000 of these? Well, if I ask my trader, he's probably going to be lower than 270 because this small market here for 2 is probably not the real market. He might be 250 bid, or he might be 260 bid. So just keep that in mind, that traders aren't going to get picked off when a client wants to come in and trade. Their models might be reflecting what's different than what's on the screen. So just keep that in mind when you need liquidity and the screens are thin, that if you need to take down a block, the bank needs to be compensated for that. And the way that they do is by widening out their markets. So now that we've talked about the dealer, let's go ahead and talk about the client. And when I say the client, we're talking about portfolio managers. Portfolio managers manage money. They could be working at hedge funds, pension funds, registered investment advisors. Basically, their job is to manage money and make money on that money. So what do they want from the bank? Well, they want the best price and liquidity for the options. So they trust their banking partners for whenever they do call them and needing a market, especially on large size, that they're going to get a fair and orderly price. Ultimately, all a portfolio manager is there to do is attempt to make money with the capital that they manage, right? That's how they make money. That's what they're employed to do. So they are making wagers with their options trades to make money. Now, also, whenever we talk about the client, what are they doing whenever they're trading options? Well, they're doing what I'm teaching you. They want to express a directional view of the stock with options. They might be bullish on the stock. They might be bearish on the stock. They might bet that the stock's going to be volatile or not volatile. The whole key is they are structuring trades so that they can take advantage of what they think the stock is going to do in the future. Also, portfolio managers rely on the liquidity of partners like banks. Okay? They need banks because if they need to take a block of options down, or basically trade a large block, someone has got to be there to take the other side. Oftentimes, you're not going to get good prices if you're trading on the screens, and you're going to need a bank to be able to provide you that liquidity. So, to conclude, let's go ahead and look at what we covered in this lesson. So, you're now able to identify the difference between a combination and a spread, outline the risks associated with combos and spreads, maximize on multi-leg options to benefit from market moves, analyze the payoff benefits that spreads and combos enable, assess the usefulness of probability through the lens of delta and time decay, and then lastly, we examined how options are used in the industry. The bottom line here is if you're going to be successful in trading options, you need to have a method, because if you have a method, you're more likely to be successful in the end.